welcome to Investment 360. My co-host this evening, Wayne McCurry, RMB Asset Management, and joining us is Keillen Ndlovu, who regularly clears out the Raging Bull and FM awards in his category, listed property. Keillen, thanks very much for your time.
Pleasure.
How do you differ from the competition, considering you clean up at these awards all the time in the listed property space?
So what we do, one, we take a long-term call. So we believe that property is a long-term game. So we don't trade the portfolio in and out on a daily basis. So we don't try to time the market. The second thing is that we keep our portfolio fully invested. So like we get about 98% property exposure. So keep cash about 2% just for liquidity purposes. And thirdly, we take aggressive bets. So we're quite comfortable with our research. We go out there, do the research, meet management, do site visits, and invest with high conviction.
Wayne, if you look at the asset classes, bonds, equity, cash, and listed property is the best performing asset class of those for 2011 year to date.
Oh yeah, no, listed property has done extremely well. It had massive tailwinds. I mean, we all know the property story. We don't have to go through that one again. But I'm a little surprised that it's performed so well this year. I mean, I didn't expect a disaster to happen, but you're not getting per square meter rental growth. You're not. It hasn't fallen, but you're not getting growth, and vacancies have gone from 4% to 10%. So your distributions this year, I mean, just to summarize it, are going to be low single-digit distributions. So, and I mean, it's not a permanent structural issue. Just this year and maybe next year, things aren't all that hot. Why do you think they've done so well?
Well, it comes back to quality. So if you look at most listed companies, they've actually had superior portfolios relative to the general market. And then some of the stocks that we pick as well, better quality portfolios, bigger shopping centers, regional shopping centers. Unlike some of the smaller shopping centers you see being auctioned, that don't belong to the listed space. So it's better management relative.
Well, let's talk about a couple of these stocks, because your top holding is Growthpoint, the biggest listed property company in South Africa. 22.18% of your fund is into Growthpoint. We've spoken extensively about their recent acquisition of the V&A waterfront. Does that, or has that impacted your decision? Have you perhaps down-weighted your scale to Growthpoint as a result of that transaction, or are you backing it?
Sure. We like the transaction, the V&A, quality assets, as we were saying earlier on, and it's a long-term story as well. And we're looking at about 6% income growth from Growthpoint, and you're getting a yield of about 7.8%. It's a premium to the market, but it's the biggest counter. It's got better quality properties as well, and solid management.
Just taking more of an overall view.
Sure.
What do you think is the right sector to be in, or subsector to be in? Not necessarily which counter, but where do you think the biggest potential lies for a bit of capital appreciation within the overall property market?
At this stage, we like the retail sector, more so the bigger shopping centers. And we've seen foot counts increase in shopping centers, spend per head increase, your dwell time increasing as well, and vacancies come down in the bigger shopping centers. You want to avoid the smaller shopping centers where vacancies actually shot up to over 10%. But the bigger regional shopping centers have got vacancies of 1.5%, 2%.
So in your investment philosophy, when it comes to the stocks, there's a big focus on quality. And
definitely.
Just looking to your exposure here, Growthpoint, your top holding, then Redefine, then Capital Property Fund, Resilient. These are the big names.
That's right.
And you're looking for that shopping center exposure, quality assets.
Definitely. I'll just give you another example. Look at Hyprop. They own some of the biggest shopping centers. They've got Canal Walk Shopping Center. They've got Hyde Park Shopping Center. We've got Mall of Rosebank as well. The Glen, all big solid assets, regional shopping centers, big component of national tenants compared to line shops.
Isn't this a bet on the South African consumer as well, though? And we've had this debate raging on the desk that the economic recovery that we've seen to date in South Africa is consumer-led.
That's right.
And the consumer is still highly indebted. There are not that many safety nets out there when interest rates start rising. How does this fall into your investment case?
So we monitor actually like the spend per head as well. So I'll give you an example. Some of the big shopping centers, they've had the turnover growth of over 10% year on year. Compared to your smaller shopping centers, they're quite flat, or some of them actually negative. So you always want to be in the bigger space, because when times are tough, people don't just go and shop everywhere. They'll spend more time in a bigger shopping center with all your key national tenants in that space.
Do you think there's going to be a squeeze? Because we all know nobody's building now.
That's right.
So all the buildings that you see with cranes on, their plans and their foundations were laid 2-3 years ago.
Yes.
So no one's building now.
That's right.
And you would assume your natural space growth, either retail or office, will be 3-4% a year. So
Yes.
within 2-3 years, the vacant space is gone.
Sure.
Where do you think the squeeze will be?
Well, actually, probably maybe start from the office market. The office market at this stage not doing well. It was actually oversupply. But now the number of new developments has come down sharply. So, but at this stage, what you're finding is that the B grade office space has got vacancies of 10 to 15%. So you need to see the economy grow and you fill up the B grade vacancies first. Whereas the A grade, which is the prime grade offices, they're actually filling up faster relative. But probably in the next 2-3 years, assuming the strong economic growth, then you might actually see that actually squeeze come through.
Looking at the smaller stocks in the
Sure.
portfolio, SA Corporate Real
right.
Estate Fund.
That's right.
Is this a good entry point into listed property for the retail investor out there, or would you stick with a counter like Growthpoint?
We'll stick with the bigger, better quality counters. SA Corporate there in that portfolio, we're actually underweight 3% relative to the benchmark. So it speaks to what we were saying earlier on that they've got a bigger component of smaller shopping centers. They've got a bigger component of your line shops relative to your national tenants. So in tough times, your line shops actually suffer first.
Does the same hold true for the likes of Vukile and Fountainhead?
Vukile is quite smaller in the index, but they've got smaller shopping centers in the townships, like your Dobsonville in Soweto, Davidson as well. But those ones, you want to be in that space. The lower income market is the space to be.
When do you take the listed property sector seriously?
I know very much so. We've got a good, I suppose, 4% of our property, of our assets in listed property. So we've got quite a big exposure to that. And we do, depending on our view of returns, we do trade that as a percentage of the portfolio. We don't trade the individual counters.
Mm-hmm.
We, unfortunately, when the same for all the big managers, can't really get the Vukiles and the Fountainheads because the tradability is just too low.
Sure.
But the big ones we can get. The big ones we can get.
How do you get around the illiquidity of the smaller shares? Or do you just have to suffer it until ultimately the sector as a whole becomes more and more liquid? We know that this is a challenge that has plagued listed property for a long
Look,
time
it's
in
got
South
better.
Africa.
Yeah.
It's definitely got,
Oh, it's
it's
definitely
definitely
got
got better, but is it still a challenge?
No, it's still a challenge, but it's getting better with some of the bigger counters, with the majors, new listings as well. But it's one thing that you have to understand when you invest in property, that's not as liquid as equities, and that's our strategy of playing a long-term game works better. We've seen some of our competitors move to cash, but to come back when the market is strong, it's just difficult. It's almost impossible.
The best performing asset class, let's go back to that of 2011 to date. It surprised Wayne in terms of how it has performed. What's the biggest risk going forward to that investment case maintaining its stance as the best performing asset class?
The biggest risk is rising bond yields or high inflation leading to interest rate hikes. What has been driving the sector year to date is strong bond yields, but mainly because of offshore buying. Foreigners have been big buyers of our bonds, and so property has benefited in the process. But going forward, you have to watch out for that. We've got bond yields moving up, and as a house, we actually adjusting for the higher bond yields. We're looking at about just income returns in the next 12 months.